Edison Byzyka joins us, Chief Investment Officer at Credent Wealth Management. Edison, so if you can only buy one side of this market, I'm going to put you on the spot here, the back to normal reopen trade or the tech growth story of incredible sales on the top line. Where do you want to be right now?
You want to be in the market, Oliver, and good to see you again, by the way. You want to be in the market for the sole reason that the rhetoric of short-term noise is not going to go away anytime soon, right? There's a lot of discussion out there that we've hit near-term peak growth, that inflationary pressure is going to be coming down the pipe, and that volatility is going to resurface. When the reality is, all these discussions are all in relative terms to what we've experienced over the past 15 to 16 months. And if any investor is willing to forego any potential mild volatility over the next 3 to 6 months, the path onward looks very healthy. And there are many fundamental factors to support that, that being consumer strength, that being even the Fed's own estimates, which the Fed is rarely 100% accurate, by the way, historically, but the Fed's own growth estimates for next year reflect a 4 to 5% growth in GDP. When you take all that into context, and when you look at the broader market, where the vast majority of equities do not reside in that growth factor, where the vast majority of equities are not overvalued to the extent that the growth sector is, then you have to be in the market, Oliver. That is the only possible way to squeeze that return over the medium term.
Edison, the things you point out here, the fundamental backdrop, there's really no arguing it, right? The potential rebound in earnings to go along with the rebound in the economy. We've seen our first step out of the gate was a lot hotter than many analysts and economists expected. The rest of the world's coming back online. We're putting the virus behind us. The counterpoint being, of course, that throughout all this, our valuations during a period of a pandemic in the market went up to levels that, according to just historical expectations, based on these valuations, would give us a very limited return for equities if the previous historical regime for valuations is indicative this time around. So to be bullish here, do you have to have a view that we're going to remain elevated at all-time highs for market valuations?
So historically, valuations in and of themselves have been the worst market timing indicators, period. Using valuations as that in and out of the market, volatility predictor, and so on and so forth, that has never actually boded well for investors. And even relative to 10 years ago, Oliver, we have to step back and realize that the notion of what it means to be invested in a favorable valuation format or structure, that has drastically changed. Earlier in the show, you mentioned ARK and you mentioned some of the growth stocks and the volatility that they've seen to the downside as the NASDAQ tries to rally its way back up. The notion of portfolio construction from what it means to accept a valuation risk, I think has shifted over time to the point where as a portfolio manager, you have to take into account a higher subjective sentiment indicator into that assessment. When I look at it from that standpoint, and of course, risk management does play a critical role in that, but from that standpoint, being in the market and accepting the slightly higher valuation risk, and maybe stepping away from mega caps and into more strategic mid caps and some of the bigger small cap names, there tends to be tremendous value there, Oliver. This year has been a true factor in that. And activity like today and yesterday in the market, where you're seeing these small cap and mid cap names outpacing their large cap counterparts. Even on an equal weighted factor S&P 500, we're seeing that outperformance from those mids and smalls. That gives me confidence that there's something brewing in there from that reopening factor that's shifting away from those large caps in the mid caps, despite that slightly higher valuation factor.
So, I mean, the slightly part, though, Edison, I mean, we're being pretty generous here with the definition of slightly. I mean, we've come down barely from the levels in the quarantine period, which have not just been tech now. I mean, the Russell 1000, you could just take a broad swath and you go through mid caps and you go through big. I mean, the wider net you cast doesn't really bring the valuation down historically. So it seems like we either have to rely on, to your point, hey, valuations can go higher if sentiment is hot, or we're going to do this thing based on bonds this time, and that changes the regime for valuations. But if we do it based on bonds, doesn't that bring us back to the reason why it's reasonable to be concerned about inflation?
Yeah, the whole bond story is really interesting right now. I think the notion of being invested in bonds and using that as maybe that equity diversifier hasn't boded very well this year because of rising interest rates, and most bond portfolios on a total return basis are negative for the year. But on that notion of valuation, kind of going back to the equity market piece real quick, keeping wraps on that valuation factor, whether it be a 2 or 2.5 standard deviation points outside of that norm, we always have to gauge that relative to the backdrop in the economy and relative to where we came from. When I look at the past 16 months, 17 months, as I referenced earlier, when you have a lack of true prudential risk in the economy, when you have a lack of a true labor market collapse similar to the 2008 crisis, our labor market is still recovering, but we didn't have a work from home mentality that thrived in such a deep bear market. When you look at all those underlying factors, I can substantiate higher valuations under that context with a healthier consumer relative to previous recessions. Within that context, though, adding bonds to the portfolio and playing the bond side at this point, then you have, as mentioned, inflation in the mix. Duration is such a critical factor in today's environment that I don't even think Treasury inflation protected securities to some degree make the most sense because of their high duration factor to begin with. I think there's that misconception that TIPS are going to protect people on a total return basis, when that's not true reality over the long term, given that their durations are north of eight or 9 years. So in the context of where to put your money, in the context of the best potential for risk-adjusted returns over the next 2-3 years, I think equities do remain your best friend. Not broad indices, specific active managed selected portfolios, as we've seen this year, have provided tremendous value, Oliver.
So when we think about the inflation risk, I mean, Edison, to state it plainly, does one have to have a view that it's not going to be long-lasting to be long the equity market at this point? Do you have to have a view that you can trust the Fed, even though they've been wrong in the past? I mean, they've been wrong by basically overestimating inflation, as we see here in a chart that you've brought to us. But what's to prevent them from being wrong on the other side, too?
You're absolutely right. I think them potentially being wrong on the other side is definitely a risk. But here's what I would caveat that. Inflation is usually referenced in terms of decades, right? We hear inflation in 70s, 80s, 90s, and so on and so forth. And if you were to look at inflation over the past 10 years, Oliver, take a decade, going back to 2011, and track actual CPI relative to the Fed's 2% target, we're essentially in line with what that decades-long inflationary picture should be. And I would argue we're in a way better place than is the case across the broader headline figures, because if you take out these mild catalysts for the last pop in that 4.2% CPI, and if you look at the mean trimmed CPI, which takes out the biggest factor and the lowest factor into CPI, we're sitting around that 2.9 to 3% annualized figure for 2021, which remains in very healthy territory. Under a scenario where the Fed is wrong, and we do see 4 or 5% annualized CPI in 2021, and maybe even 2022, that 10-year snapshot is very much within the context of what a decades-long inflationary snapshot could and should look like. So I would argue, I think it's too early to sound the alarm for an elongated period of inflationary pressures, especially when we truly understand the catalysts and the transitory forces within each CPI figure each month. And the way I see it over the next 3-4 years, Oliver, two things are possible. Higher CPI is definitely in our future, but the only way to substantiate that, even at a marginal degree, is equity market participation. It's not gold. It's not the volatility you accept with commodities, and it's certainly not TIPS or any other bond-like instrument. This has been the only true statistically significant case over previous CPI cycles to the upside.